Ladies and gentlemen, welcome back. Here comes the last topic of day one. But there's day two tomorrow, so there's a lot more coming. Now, after heavyweight topics today, we plan to end today's day with a lighter but brighter topic. As we know, 5 crore plus new investors have come to equity markets over the last 1.5 years. So does this convey that India is seeing a major transformation from a concerned and risk-averse mindset to a happy and risk-taking mindset? Well, to answer that question, we have panelists on board, ladies and gentlemen, very eminent ones. We have with us Mr. Ashish Somaiya, Mr. Krishna Narnolia, and Ms. Radhika Gupta. And Mr. Mohit Bhagat is going to be moderating this session. Now, let me take a moment to introduce my panelists. Mr. Ashish Somaiya is the CEO of White Oak Capital Management. He is an experienced professional and has experience in scaling up and managing relations across well-known AMCs like Motilal Oswal AMC and ICICI Pru AMC. With a master's in finance and bachelor's in science, he brings 2 decades of industry experience. And he was responsible for strategizing, growing, and managing the operations of Motilal Oswal AMC, a niche-focused expert equity boutique based on its time-tested buy right, sit tight investing style. He has been responsible in the past for sales and distribution of one of India's largest AMCs, ICICI Prudential AMC, for their MF, PMS, and real estate offerings. Now we have with us Mr. Krishna N. Narnolia, who is the founder and CMD of Narnolia Group of Companies. And he's respected and widely known in this industry for his in-depth work on India growth story. And today, he's one of the most sought after speakers and columnists in the field of investment. Under his leadership, the company has emerged as one of the fastest growing and most respected brands in the country, winning accolades from the industry leaders and all stakeholders across the globe in the specialized field of fund management, investment advisory, and indices management. We have with us Ms. Radhika Gupta, the MD and CEO at Edelweiss AMC. She's a graduate from the Management and Technology program at the University of Pennsylvania, with joint degrees in economics from the Wharton School and computer science engineering from the Moore School. And she started her career with McKinsey and Company and then progressed to become a hedge fund manager with AQR Capital, one of the world's largest systematic asset managers. She then moved to India to start her own venture named Forefront Capital Management, an alternative asset management firm, which was acquired by Edelweiss in 2014. An asset management professional with experience across asset classes and investor segments, she successfully led Edelweiss's acquisition of JP Morgan's mutual fund business and Ambit Capital's AIF business in 2016. Now, Ms. Gupta is a true global personality. Having traveled across 4 continents, she's the founding president of the University of Pennsylvania Alumni Club, a member of the Global Leadership Council of the Management and Technology Program, and a board member of the Association of Mutual Funds in India. She's also a keen micro-blogger on Twitter and an avid bridge player. Her unique life story is narrated in the video, The Girl with a Broken Neck, and that garnered over 1.8 lakh views. Now, the session, ladies and gentlemen, will be moderated by Mr. Mohit Bhagat, who is the Channel Business Development Head at Alchemy Capital. A senior financial services professional, Mr. Mohit Bhagat has an experience of over 20 years in asset management and wealth management businesses in India. He has served in various positions in geographies with firms like ICICI Bank, ICICI Prudential MF, Franklin Templeton MF. Academically, he's an MBA in finance and an IIM alumnus who has been associated with Alchemy Capital as head to their channel business since January of 2017. A very warm welcome to our esteemed panelists and our moderator. It's now over to you, Mohit sir. Please take it away. Mr. Mohit Bhagat,
Thank you very much.
moderator.
Thanks, Aishwarya, for the elaborated introduction. And why not so? I think this panel does deserves that kind of an elaborated introduction. Now, while we basically look at, and as you said, the context very clearly, the topic that we're basically looking at is more or less set up by Aishwarya only. While she mentioned that there have been 5 crore new investors. Now, just to kind of add on to a couple of more objective-based points out there, 5 crore MF SIPs. We are talking about 1.5 crore plus investors who have come into the stock markets in last just about 12 to 18 months. We are also looking at the overall contribution or the participation of the retail investors within NSE, which is enhanced from 39% to nearly 45%. Over last year and a half. Now, all this is very clearly indicating that the topic that we're discussing today, that is the mindset changed, but it looks like quite a bit. But then that, coming out from last 2 decades of experience, it puts me, into kind of a deja vu and puts me to that first question that I'm going to put up to all my panelists out here is to say that, is this the thing, again, cat chasing the mouse or mouse running away from the cat, which essentially means to say that is it the bull run that has gotten in all these investors, or is it the investors who had gotten the bull run, right? So let us basically understand this, that how is it different from the previous cycles that we had seen back in 1998 to 2000 or 2006 to 2008 and so on. And if you feel so that this is different, then we'd like to understand as to why. I'll start with Krishnaji out here, and then we'll go to the others. Krishnaji, over to you, sir.
Yeah, thank you, Mohit. First, I think that there's a clear difference in what happened in the, say, tech boom and during the Lehman crisis times. Because normally the market moves in sometimes smaller cycles and sometimes in larger cycles. Normally the smaller cycles are of 3 years, and the larger cycles that comes normally after 8 or 10 years. So, say 94 to 97 there was cycle, 97 to 2000 was a bull cycle, then 2000 to 2003 was a bear cycle, and 3 to 7 was a bull cycle. So there's small cycles of 3 years, and then in between you see 8 to 10 years of cycle, say Harshad Mehta, then after 8 years you saw the tech boom, then after 8 years you saw that Lehman crisis. So this particular time, it is not like that kind of bull market, large bull market. It was a very milder one. We are just a part of a very milder bull market. We normally think that we are in a bull market because the market has grown significantly over the last 1.5 years. But if we see the data from 2018 till today, the market has just given just a return of 13% CAGR. So it is just in compensation against what it did, because the correction that we saw in 2020, so that was a non-economic event. It was just an accident. It was nothing like a collapse of a big bull market. Because of some non-economic event, it fell from a very reasonable level of 20p, then it came down to some level. So market just compensated against that, because so it was not a typical bull and bear market cycle. It was, you can say, bust and bull kind of bust and boom kind of cycle. It was not a boom and bust cycle. It was a bust and boom cycle. So I don't think we can compare this particular uptick in the market with the likes of, say, tech booms and the Lehman times. If we analyze the data to get an even better clarity, see what is happening in the reality, what the data says. In the overall turnover in the exchange, the turnover of cash market has grown by 100%. Options market has grown by 500% in 2 years. But the futures market turnover has grown by just 30%. And even within that, the exposure of the Nifty has grown significantly. The stock future is much less. So how we just can't compare with the Lehman times or the tech boom times when the P was Nasdaq, the Nasdaq P was 200, and in India the K10 you just don't know what was the pricing, and in Lehman times also. So I think and this time again the India growth story actually has taken a proper shape in, say, somewhere in 2017-18. So now this particular run is backed by a very strong foundations of India growth story. So I think even one more thing, if you analyze the data now, you will say how the investors have become very smart today. They are opening accounts with the discounters like anything, and but they're using that platform only for their transactions. While it comes to parking their holding, they still believe in the banks or traditional brokers with very strong balance sheets. So they are not euphoric. They know, because say, just for an example, the largest discounter of the country, he has 2 times more active clients compared to the largest bank broker. But when it comes to holding, the bank broker is holding is 15 times more than the discounted broker is holding. So when it comes to serious money, PMS money or AIF money, or even different other asset classes, so they are playing very safe. They are parking it in a very, with a very safer hand. So all these things, I think there is nothing like that kind of euphoria that we saw previously.
Thank you, Krishnaji. Radhika, how about your perspective on the same?
I think there are two sides to the coin, and I won't cover the market and data aspect of it because that has been so covered. Firstly, I don't think that it is fair to, you will never have an objective answer to the question, have we become more risk-taking in a bull market? Because I don't think any assessment of risk appetite happens in a bull market. We're all risk-taking in a bull market. I think it happens in a bear market. And I think, to some level, whether it is, globally or whether it is any cycle in India, you have a certain set of investors that enter at the beginning of a bull market, make a lot of money in the bull market, make, of course, the same set of mistakes. And by the way, as those investors age, they also grow up. So my belief is, for instance, 2003 and then the subsequent correction in 2008 really aided a lot of equity investors. So I think equity investors, for instance, got a lot smarter, at least that generation. There is now a new generation of equity investors. But, to some extent, you can't analyze risk taking in a bull market. The brighter side to this coin, however, is I think there has been a lot of talk of young people and young investors becoming an important driving force in this market. I happen to talk to, quite a few of them on social media, and a lot of them write in. And I think, one thing that you can't take away is that the younger Indian is getting more aspirational. And he or she is not only getting more aspirational with their money, but with their career. Their habits are changing. So the habits are suddenly not about home ownership. You'd rather be trading cryptocurrencies and, increasing your wealth than perhaps buying a home or perhaps buying a house. So I think the habits of the young Indian are changing. And that change perhaps may be structural. That makes me excited. I think the other thing is in terms of risk appetite, the sense of adventurism, at least in a bull market, is going up. And there are two things I see. One is the openness to new asset classes or new ideas within the same asset class is definitely up. So, there was probably a time, I sell international funds. Among the things I do at Edelweiss Mutual Fund, 5 years ago, perhaps a China fund was a very esoteric idea. And I used to tell my team, what is this? It's very complicated. Kaun kharidega? Now I think it's a very vanilla thing. And, when I see the things that are being put out and actually bought, it feels very, very vanilla. So, and I'm not even coming to cryptocurrencies and some of the more, exotic stuff going on. So I think the appetite for more evolved stuff has gone up, and it's gone up for many reasons. There's more information out there. There's more accessibility out there. Today, I was driving on the road to work, and my driver, and he's a 45-year-old man, he happened to see a Tesla on the road. So first he asked me, "Madam, is that a Tesla?" And then we went near the car and I said, "Yeah, it's a Tesla." And he said, "Should I buy some electric vehicle stocks?" And there is at least, and then I finally convinced him to do an SIP and a mutual fund. That's a separate point, but that awareness is there, and that awareness is incredible. And secondly, as I think a younger brand, we also see the openness of young people. Risk-taking is not only the asset classes you invest in. We also see the openness of younger brands. So I think it's become a much more meritocratic generation. The fact that younger brands are able to grow, I think these are signs of increasing risk appetite. So at some level, yes, it's a bull market. We shouldn't celebrate risk appetite, but there's optimism about the young Indian getting more aspirational.
Well, interesting. And I'm pretty very sure that had that not been your driver and any of your guys out there, who'd else be asking that question? But with that, it brings me to Ashish. Ashish, with all these perspectives where Krishnaji's point of view is that is more structural and very interesting point from Radhika, that it is, changing with the generational change also, the changes have been brought into. What are your two bits out there?
So only two bits. So I'll just basically clarify a couple of things. I actually agree, there are wheels within wheels, or there are cycles within cycles, or there are short trends and there are long trends. So I agree with all the observations. I think the long trend was always that, there is a adage in English which says habits change with generations. So the long trend has been there, right? If you ask my mom's generation, I always do this micro research, which is that if I'm in a big audience, I always ask them that when the word interest rate is said, then what number comes to your mind? I think for my mom's generation, it would be 11-12%. For our generation, the word would stand for 8%. Today, youngsters, and one of the most popular banks in India, has popularized 4 and 6. So today's younger generation, I'm quite sure that if you use the word interest rate, they will resonate more with 5 or 6. So I think that is one that signifies one major change, right? Second is that digitization, and the third is the demography itself, correct? So, if you say, for example, small saving schemes or postal schemes, etc., it's not just about the interest rate that they're paying. It's not just about the distribution that they have. The point is that they don't appeal to youngsters because they've not kept with the times, right? A PPF, for instance. So I think, the expectations of a younger generation, if you see by and large, you have younger people in the country, then needless to say, the risk appetite automatically tends to go up. That's the long trend. So digitization, interest rate structural changes, ability of old world investments to keep pace with new interfaces, general, by and large, there will be times when there will be small trends which are related to the bull market and those kinds of things, correct? So I would say that, it's here to stay. The long trend is not going to change. Only the smaller trend will keep fluctuating, correct? If the market goes bad, when the market, Radhika is absolutely right. When the market is booming, everybody is an investor. And when the market is down, I always tell people, risk appetite. She's right. You should never judge the risk appetite in a bull market, because I always say that in our country, people's risk appetite swings between a bank deposit and Unitech on the other side. In between, there's nothing. So either they are buying EV stocks or they are putting money in State Bank. There's nothing in between. So she's right. You should not judge risk appetite in a bull market, but that's only to the extent that this small trend will keep changing. The big trend, I don't think, is going to reverse.
Okay. Thank you, Ashish. While Ashish, Krishnaji did kind of touched upon the reasons, right? Some of the structural reasons, while he pointed out the bull run, the interest rates, the fintech catch up, all those, some of those reasons, which essentially is enabling this shift. And we all are on one common agreement that, this shift is there, and it is there, it is structural, and, there are long trends and short trends. Are there any other reasons, other than the macro pieces? And Ashish, as you said, so as per some of the common ones on the commoner end that people use it as part of the bull run can be FOMO. And it also can probably, I don't know if that can also be related to the excess amount of time that people had during the pandemic times, while they were probably looking at dwelling more on the investments than, their professions. But maybe, Krishnaji, because this is a point that, is already part of your research paper, and I'm aware of that. So let us basically have it from your side also that, as per you, what are the key reasons, what are the key aspects which are enablers to this new trend forming up?
I think there are a couple of factors. India growth story in a very proper way. It was based on my study of the 10 countries. I could find that there are a very interesting couple of factors. They have a very close interrelationships. They influence each other. And I feel that in India, perhaps the Rahus, Ketus, and the Mangals and the Sunnis of the world are placed such suitably that the sun, they favor the rising sun of India. So what I think, there are a couple of very important factors that has influenced the rising risk appetite, and that will ultimately trigger the India growth story. The first and foremost and the most important is the rising per capita income that you all know, because the risk appetite is directly linked to disposable income, which is again linked to the per capita growth. And it was seen in all the 10 countries that I tried to study that the per capita income grows disproportionately, and the disposable income also grows even more disproportionately when the per capita income crosses the minimum threshold of roti, kapda, beti ki shaadi and rehne ko chhat ka needs. The moment it crosses that, so say in the context of India, it took around 70 years to reach the minimum threshold of $1,500 to $1,700 of per capita income. But it will take just 7 years to double it to 3,500. But by that time, the disposable income and the risk appetite will grow 4 to 5 folds. So this per capita income, we have just crossed that level just 3 or 4 years back. So this is one thing that has changed the very structure. And the second thing on top of it is the per capita. Again, the risk appetite depends on the overall demography, favorable demography, the median age, the working age ratio, and even within the non-working age, how much are dependent, how much are youngsters, how many are the old ones. So all those things, I think out of the all 10 countries that I try to study, India is most suitably placed. And I think these two factors, per capita and the demography, when they align properly, that triggers certain factors. The most important is the socio-economic or socio-cultural shift. So that is happening in India. Because the per capita income, on top of it, the demography, that triggers. Say, for example, the first thing that it triggers is the urbanization. People looking at the growth of India growth story, sabse pehle, they start moving to the cities. The moment they start moving to the cities, what happens? The joint family breaks into nuclear family. And in a nuclear family, what happens? Normally the decisions are people invest more in on education. And the fourth thing is that the decision making gradually moves from the karta of a joint family to the youngsters of the nuclear family. So the youngsters in general have a much higher risk appetite compared to the karta of a joint family, who always believe that tete pao pasare jete lambi sor. So what happens, the youngsters in turn starts believing they have their own way, because structurally they have higher risk appetite because of the age factor. They are much more aware because of higher literacy level. And they can also now import knowledge from in the Googleized world. Earlier, we had just two worlds, the rural India, the urban India. Today, we have one more, Google India. That overshadows both the rural and the urban areas. So these people do play a very important role, not only in taking higher risk, but they also influence the decision-making of their parents in taking higher risk. They educate them. So now this is one major shift that takes place when the two factors of per capita and the demography supports it. The fourth factor I think is very important is the history and depth of the stock market or the capital market. Normally what I found that in all the 10 countries, when the market evolved, it just saw at least more than 3 bull or bear markets. By the time when the country sees at least 3 major bull or bear markets, people know it has to pass it very successfully. Say in Indian context, we have seen the Harshad Mehta, Ketan Parikh time, and the Lehman Brothers. So now, when you see through the 3 successive bull markets, and when the market ultimately evolves over it, then what happens? The youngsters in the family and the elder person in the family, now they say the common things. Earlier, in the Harshad Mehta or the post Harshad Mehta time, what used to but after 3 successive bull and bear market, what happens? That both parents and the child sit together and they talk, okay, bhai, thoda so risk se thoda isk karna jaruri hai. So this happens. So this is something that India has successfully passed through, and in fact, is that it has emerged very stronger after that. And the fifth and the last important thing is the factor that triggers it, risk appetite is the evolution of the regulatory framework. Even the regulators learn from the past mistakes. So this is something that is happening in India as well. We are finding it very difficult to deal with them, but actually this is increasing the confidence or the trust of the investors. So I think all these things have played a very good role in shaping the overall risk appetite, and that will eventually trigger the growth story of the India. So I think it's a good thing for India that's happening.
Interesting analysis, I should say, Krishnaji. But while, this all interesting analysis of socio-economic understanding of the reasons has been put up out there with Krishnaji, Ashish, I'll come to you and get down to a step further while we're talking about the newer generation. As Radhika mentioned, let's talk about the new adventurism of the newer generation. I mean, newer generation only of investors, not age-wise per se. And let's talk about the newer understandings, because this time what we've seen is that the catch-up is not only limited to stock markets. It's not there with only equity markets. It's been there in the private markets, right? It's been burning and, bursting out there in the private markets, and not to be missing the into crypto, right? Which has been another piece out there. So how do you basically treat this adventurism, and where do you think this is leading out there?
There is, I think, there are positives and there are negatives. Adventurism is, I think that if we say that ability to take risk or appetite for risk is termed as adventurism, then there is slight, say, negative connotation to it. It would be adventurism if people are overexposed, right? Or if people are investing indiscriminately. And then, of course, every time there is a teji, then there is some amount of indiscriminate behavior. But I would not say that everything is adventurism in that sense. The reason I'm saying this is because if you see the US, for instance, the history shows that as markets become more and more evolved, alpha moves to the private market, right? So if Indian affluent or high net worth investors are showing increasing penchant for investing in private markets, nothing wrong with that. It's just that if somebody has 100 rupees in the portfolio, then how much is in the private market? Because private market, obviously, one, it has illiquidity, second, it has mortality. So that is something to keep in mind. But I think it's a welcome move. I think it's good for the markets. It's good for investors. It's good for the whole ecosystem. Even when it comes to cryptos, if you really ask me, I don't think I'm very, very qualified to comment on. Feel that, one of the things I do is that nowadays there are a lot of these Twitter spaces which happen on crypto. I never speak in any of them because I'm not qualified to speak, but I always attend and I always listen. And here are my 2-3 fears. I think the guys who are doing all these, I think technologically, I don't think anybody can challenge them. But more often than not, what I find is that their understanding about governance, their understanding about regulatory affairs, their understanding about finance, understanding about taxation, in all humility, I can say slightly suspect, right? So when it comes to cryptos, for instance, whose advice are you taking? See, just because somebody is technologically superior to you and because they can create a bunch of products, I would respect that, but I would not suddenly start thinking that they are an expert when it comes to finance or taxation or FEMA rules, for instance, correct? So that's where I think my fear lies, right? That's what I think investors should be wary about. So is crypto here to stay? Probably yes. Blockchain even more so, yes. But in its current form and avatar, I don't know. I would be slightly worried about it, actually.
Fair. Thank you, Ashish. Radhika, since you've seen both sides of the coin out there, I would like to kind of put up the same question to you with an extension to the point that if at all you feel that with whatever view these changes have been coming in, right, how do you find the acceleration to that being, catching up in the Indian diaspora or Indian markets as such?
So firstly, on a lighter note, I have to give it to Ashish. You were just talking of generations. Ashish, if you are saying that Unitech is the far end of risk taking, then you are clearly one generation old. I mean, you know, a young person would say that is like so 2008. So you are really one generation.
I have to be diplomatic, Radhika.
Yeah.
I cannot give an example from the current market, right?
Yeah,
I can give example of what is done and dusted.
you got to say virtual digital assets, NFTs. I mean, Bachchan is on NFTs, and here Ashish is saying Unitech is risk taking. It's like 1 decade ago, Ashish. So,
Yeah,
I mean,
I'm sorry. You're right. I'm 1 decade behind.
so I had to say that. So, look, I think Ashish and Krishna have made a lot of points, so I'll keep this reasonably brief. One is, I think, what is happening in India, especially as far as young population rise in capital markets, it's not unique to India. You've seen the same trends in the US over the last 2 years because of low interest rates and the fact that people are sitting at home. You've seen the same trends in China. You've seen the same trends even in the private markets in Indonesia and Singapore. I was at a NASCOM event, and these trends are all over Asia. So, it's nice to believe that India lives in an island, but I don't think we live in an island. I would just add to one of the points Ashish made, and I also I have a secret account and I lurk on some of these Twitter spaces, because if I lurk on my real account, they try and make me a speaker. And the one thing I would say is good and bad. We live in an information age. So this generation of investors has a lot more access to information. I mean, I gave you the example of my driver, and I promise I don't talk about EV stocks in the car. But the fact is that there is so much news out there. There is so much information on private markets out there. There's so much information on crypto out there. So this is a generation of investors that has access to a lot more information. And there are specialized forums. There are forums for doctors, there are forums for women investors, there are forums for young investors. The problem with that, unfortunately, as Ashish said, is that who do you take advice from? There has been a whole rise of personal finance influencers that you see on some of these spaces, and not being politically correct. I worry about who people take advice from. I mean, when you see events happening at midnight or 1 a.m. and, random people are giving advice on finance, I worry about what that will mean. So I think that is the challenge of the times that we live in. On private markets, I would say it's a good thing. Look, the interest in entrepreneurship in India, whether you start from Shark Tank or all the unicorn listings, the interest in entrepreneurship is actually a very, very good thing. As long as people are discerning about their investments, comes when you have 5 bad fintech or whatever new age IPOs, and people start complaining that, oh, SEBI should take action on how these IPOs are priced. The regulator is not going to take action on how these IPOs are priced. We have to be a lot more discerning. So I think on private markets, they can't be divorced from public markets. But as long as people are making sensible decisions with the right amount of allocation, it's okay. On crypto, I've been trolled a lot for talking about crypto. My short point is, I don't think blockchain is a bad thing. I don't think crypto is a bad thing on 2 conditions. If it is regulated, and at least the budget is showing direction that it will be taxed and hopefully regulated. Because again, financial literacy compared to the US is very, very low in India. And we've seen that when something goes wrong in financial markets publicly in India, it is a mess. So when NSCL happened, when all your chit fund scams happen, it becomes a mess. We're not a very financially literate population compared to those markets. So that's not a great comparison. So as long as it's regulated, as long as there's someone to go to if something goes wrong with your money, and as long as you come in for the right reasons, not because you saw a film star promising to double your money on a Digi ad, it's all fine. So any asset class's growth is good if people are coming into it regulated and for the right reasons and with the right advice.
Fair enough. Thank you, Radhika. Now, Krishnaji, that brings me to another key issue. And the issue is that with all these new investors, the plethora of new guys coming into the markets, private markets, the other markets, right? We already have been kind of pointing out the key risk is advisory, and you play a critical role. Your firm also kind of advises a lot of investors out there. Now, what do you think is the right format to probably, look around out there? Because, out here we are talking about, this point in time, we are talking about all this, facilitation being done through largely out of the digital base. Now, there may not be involvement of, somebody out there. And as both Radhika and Ashish said so, there may not be an authentication of people who have been advising on the subject matter. So how do one basically, make sure of what they're getting into is all understood, well, kind of depth into, and, how do one make also sure that while they have already got into, right, they are being kind of guided to the right path, right, on that particular domain or zone?
Mohit, I think because this is perhaps the only place where a person with a salary of 25,000, with all due respect to all the RMs, advises a client to invest 1 crore or 2 crores of investment in equity. So it's very unfortunate. You won't find it anywhere, be it comes to the medical or the medicine or the, say, in the lawyer. Or so all of them are qualified. So unfortunately in India, that's not happening, but gradually it is evolving. I think what is very important is that while advising, you should be very clear. Say, in case of a doctor, you know what is your role. In advisory, it's a very simple thing. Are you advising an investor or you're advising a trader? If you are advising the investor, it's very clear. Ultimately, what should the investor expect? Investors should expect return. Investors should expect something that is not happening in India, that has to happen. We focus very much on that. And how much risk that you have taken against every unit of superior return that you have generated. How much risk have you taken? Now it is just a solo movie of a single star without a heroine. So that risk and return, they are the heroes and the heroines. It has to be a combination of that. It is something that is missing. So I think going forward, there are a couple of things, and even not just risk alone. Going forward, what will happen? People will ask, higher return will no longer be an enough answer. They will ask, भाई इतना extra generate करने में, what risk have you taken? उसके बाद second question will be, क्या finally have you performed vis-a-vis the benchmarks? Second, vis-a-vis the average peers, vis-a-vis my own expectations that you had set at the time of selling your funds to me. Because ultimately you have to perform, the risk-adjusted return has to be absolutely higher than the FD. It has to be relatively higher compared to the benchmarks and average peers and the expectation that you had set at the time of selling. And it has to be on a consistent basis till the time client is invested there. So I think a couple of things. I normally say that at the time of advisory, there are a couple of, I think, concepts that can be used. First is that mutual fund sahi hai will no longer be a enough answer. कौन सा म्यूचुअल फंड सही है, मेरे लिए कौन सा म्यूचुअल फंड सही है, that will be the question. Higher return will no longer be the enough answer. What risk you are taking and how much superior return that you are creating over a period, that will be the question. So I think a couple of things, the risk will play a bigger role, and we can't expect a normal relationship managers or normal advisors who can advise them. Now, when it comes to trading, so then when it comes to trading, the things, the game changes. So there, even within the game, within the trading, there can be one extremist. Chalo theek, aaj khelte hain hum log. There can be one who will take a very balanced view. They will play with the game of probability. Then again, things will be very different. So these are the things I think, unfortunately, it is evolving. People, the technology has helped to that has helped to make the entry barrier very easier, cheaper. But unfortunately, actually, if we drill down, our industry is basically a knowledge industry. The trust, the technology, human touch, and capital, or they come after that. So since I think people who has genuine knowledge, they shouldn't. Now today, what is happening? The people are resorting to discounters because they want to save brokerage. They don't want to make money. They want to save brokerage. So these are the things going forward. I think by the time over a period, investors will learn that it is ultimately a technology. If you are taking a discounting route, you should have the knowledge. And if you don't have, you should have your advisor who is qualified enough, who can genuinely guide you, who can genuinely take you through the ups and downs of the market, who can provide you emotional support during the extreme ups and downs of the market. Because that is something, because normal investors are financially illiterate. They don't know what to do. They need proper rational and emotional support during the extremes of the market. That is something, unfortunately, that is missing in India, but that will evolve. That will evolve over a period.
Okay. Thank you, Krishnaji. Now, Ashish and Radhika, this brings me to another set of very interesting risk question. How to set expectations. We have been coming in from a plethora of these new investors where they've seen money doubling in 12 months, 18 months. They've seen money made into anything that they must have invested into over last maybe, few quarters out there. And now, how do you tackle around with this challenge of getting them optimized and understanding of the real return out there, which would be the long-term return out there? And since you both have been running, one of those mutual fund houses, how do you guys look at it, and how do you basically try and kind of tackle around this enormous challenge, if I have to say so? We'll start by Radhika and move to Ashish.
Oh, I thought we'd get to hear Ashish first, but okay, it comes to me. I'm glad you asked this question, and I think we've spent quite a bit of the panel and fairly discussing the behavior of investors, what they do, what they don't do, who they listen to, who they don't listen to. But ultimately, I think we are at a forum of asset management professionals, whether AIF, PMS, MF, etc. And there's only so much you can control of the outside. And the question is, how can we be more responsible asset managers so that what we can do, what is, there's only so much that you can control. You have to control what you can control. And I think there is a very serious responsibility. When you say the word mutual fund sahi hai, I think the sahi hai are actually they are heavy words, they're meaningful words. And so I think finally there is a responsibility that I certainly feel as an asset manager, that do whatever you can to influence behavior in the right way. And I think there are things you can do. For instance, one of the things that we've been doing is there are certain kind of products which are good for investors, where there are chances that, the investor outcome is not going to be a terrible outcome. So one of the reasons our house and I go singing and dancing, I've got a bad name for just promoting balanced advantage funds everywhere, but there is a reason, because we know as a fund house and for investors, when you come into products that are more moderate risk return, it sets expectations right and their journey is likely to be right. A few years ago, we had a phase where, and Ashish should recall this, international funds were doing well. We had a China fund where people were so excited about the returns that if there was a 2-day holiday in China, our call centers and social media would get jammed and people would tell us, I'm upset the NAV is not out because I'm used to it going up every day. And we actually dialed it down and told people, listen, because there will be a phase when China turns volatile, and China did turn volatile, and those same people will run jumping back on us saying, "Mujhe China nahi samajh aata." So we moved people to a lot of systematic based investing. You can control the number of NFOs you go out and do. So there is a lot that you can do as an asset manager, I believe, that all of us can do as asset managers, in terms of setting expectations, in terms of getting people into the right products, in terms of warning people where things will go wrong. And I think it's our commitment as an industry to do that, because we'll build more robust businesses for ourselves.
Right. Thank you. Ashish?
Yeah, so, 2-3 things. I think one is obviously Radhika has spelled out that what the industry can do and, what the industry should do. Needless to say, that's all on the right. You have to show people the range of outcomes, that how bad can it get in bad times, and not to just go by the good times, etc. And the regulator has played a good role, in terms of making sure that the reporting is standardized. It's happening now in PMS also. So that is one. 2 things I can just tell you. One is that, it's not that a lot of people just entered only in 2020. I know for a fact that even when demonetization was announced, after that, a lot of money moved into banking channels. Interest rates fell dramatically because you couldn't use cash. Digital adoption started rising, correct? So at that time also, if you remember, even pre-COVID, there was a huge gush of new account openings in brokerages, SIPs, etc. Now, if you really look at it, 2016, 17, 18, a lot of people entered the market. And by 2020, they must have been, thinking, what the hell, where have I landed? So people who came in 2016, 17, 18, by 2020, they must have thought we have ended up in the wrong place. And people who started in 2020, they must be thinking, what is all this hue and cry about? It's so easy, right? So the message is that it's not as difficult as it appears to the guys who entered in 2017, 18. And it's not as easy as it appears to the guys who entered in 2020. I think that is something people should keep in mind. The other thing which I'll tell you, we can put in our best efforts. We must put in our best efforts because we owe it to people and we are responsible. And I'm not trying to be fatalistic, but I can tell you one thing, which is my learning after, since Radhika has already said I'm old, after 22 years in the industry, my learning is one thing, that the human mind is just not suitable or just not attuned to investing in the stock market. I'll tell you the reason. Because the human mind by nature needs closure. See, anything goes wrong, we need an explanation, correct? Like market falls today, it can fall for myriad set of reasons. It can fall for 20 reasons, but by evening you will get a note. It has fallen for 1, 2, 3, 4, tuck, tuck, tuck. These are the reasons. Why do we do all that analysis? Because human mind needs closure. See, if something goes wrong with a relationship, you would like to know why this happened with me. If something happens somewhere, you would want to know why has this happened. So human mind wants closure. We want certainty. We want to know what is right, wrong, good, bad, black, white, left, right. We would like closure and certainty. But stock market is something which does not allow for closure and certainty. Stock market is something, F. Scott Fitzgerald, who is one of the big American philosophers, he said in the 1930s that the test of first-rate intelligence is the ability to hold contrasting ideas in your mind and still retain your ability to function, correct? So when March 2020 comes, part of your mind says world will come to an end. And part of your mind believes that no, human beings are not the next dinosaur. So nikal jayenge isme se, right? So human minds want closure, whereas stock market, the prerequisite of being a successful investor is to retain your ability to function even when you are 60% down. Correct. So what I'm trying to say is that we owe it to people. So we should make right communication and offer the right products like Radhika said. But at the same time, we should all understand that from time to time, we will have disastrous experiences. It's just that you should hold your nerve and you should retain your ability to function, without panicking.
Fair point. Krishnaji, your conclusive remarks on the same point, sir?
I think people talk about returns, so I don't want to say anything related to return. The risk is something that is very important. So every investor should know what should they expect. Say they should spend a lot of time in asking questions. What should be my expectations? They should talk to the people they believe. What should be my expectations? Because the advisors will come, they will sell anything, they have their own interest. So you can't just depend on them. You should know what you expect. What should you expect? So first and foremost thing is that what should be my expectations? The clients or the investors should definitely know that. And one part of that will definitely be risk management. What extra risk I am taking? Can I take the risk? Should I take the risk? How much of the risk I can take? I think these are the few things that the investors in general, he should be very much aware. He should be very cautious. He should be knowing that people might come with some ulterior motive. They might have their own targets to sell. They might have their own incentives to sell. But I don't want to get sold to. This is something that I want. This is something. So they should know what they want. Then they should ask right questions. Then they should review it periodically with the fund managers. What are the things that you've done? So I think it is a time that investors should try to ask right questions. That's something.
Thank you. Well, I think that brings us to the end of this session. Thank you, guys. Thank you very much. It was a very enlightening session, and I'm sure we all are conclusively building up a understanding that, this shift is certainly there and it will be building in. And as it builds, so it carries its own sets of risks and understandings which needs to be taken care of. And ultimately, this all looks to be moving in the right direction, right? And with that, we will conclude this session. Thank you very much once again, guys.